investors' interests and entrepreneurs' interests are not always aligned, right? I mean, particularly in venture, what venture firms need to find are companies that are going to grow an extraordinary amount to be able to return the fund. But there is one place that they are aligned, and particularly for entrepreneurs and operators trying to figure out how to maximize their personal returns in the companies that they're building, is that if an entrepreneur is in a situation where they have an option to not take money, but they also can see if they put $1 in, they can see the return they're getting, and they have an idea of where that curve starts to flatten out. If you are able to do that, you can make a decision in the context of an investment with a return. So you could say, well, so simple math on this, let's say you're a $10 million business and you have the right type of telemetry to know there's a clear path to be able to take your marketing spend from $1 million to $2 million and grow twice as fast, still hitting or improving on the unit economics that you have. Then you have an investment decision to make. It's a math problem, which is I'm going to take some dilution, but I can see for instance, if I grew from 10 million and I was growing at 40% a year as opposed to 20% a year, well, that company is worth more because the top line has gone up and you've improved the unit economics. But the other reason is because that company's more valuable because it's growing faster. Now, the minute you're able to do that as an entrepreneur, the value of your business to an investor skyrockets because we're talking about true growth capital. So welcome back. This is our 4th episode, and this month has been really exciting. We've had some spectacular guests, and I've learned a lot, and it's been really, really fun. And thanks to all of you for your comments. It's really, we're off to a good start, and we're pretty excited about it. Today, we're going to do something a little different. We're going to spend a little time having a conversation about a lot of things that we're seeing with companies that we're working with and talking to around the world. Zan has joined us, Zan Bennett, who works with us to go back and forth and talk a little bit. So welcome, Zan.
Thank you, Paul. I'm excited about this episode. I think I have the unique privilege of being on a lot of these calls that we have with companies of all shapes and sizes around the world that are all struggling with, in some ways, very different issues, but in a lot of ways, there's some clear pattern recognition. So what I've done today is I've put together a list of some of the questions that we hear all the time. Some of the things that CEOs, CFOs, and CMOs are sticking points. Like these are the things where really smart people tend to get stuck, and they're like, okay, hey, if I could only figure that thing out, then that'd be able to unlock this massive category of growth. So I'm just going to go through one, and we got like 5 to 10 questions here. We're going to go through. Let's see how far we get, and I'd love to hear your insights because I've heard this a bunch of times before when we're talking to people that are trying to solve these issues, and I think that there's going to be some value here. So let's jump right into it. Let's start with a broad question. What are some of those common mistakes companies make when they're trying to scale the operations? Meaning that those teams and those the tech stack around those teams.
There's a very, very tricky thing as companies look to scale and they transition from the product market fit phase into the scaling phase. So traditionally, people think about that as around 10 million of ARR or 10 million of revenue. And the reason why it gets challenging is the mechanism, it's one of those things, what got you here ain't going to get you there, And the reason for that is that, the product market fit phase is about this iterative process and a variety of tests, small tests where you're trying things out. And then you start to find that something that's going to work, which is deeply gratifying because it's very upsetting to be in a situation where you think you have something great and just nobody's responding. So it's that, getting the product right and then very rapidly testing. And you get something that's working and you try more and more and you pull on that thread and it continues to work and you think your work is done. And in fact, it's really, really beginning. And so the process of not, adding tons of infrastructure and capability and really being very close to the problem is an essential part of the phase 1. But phase 2 requires something else. So often what happens is that companies go with a high, deep sense of relief. Great, we got it worked out. We're buying media in these channels, and we're doing these things for organic and so on. It's working, and look at how nice the chart looks, and we're on our way. But at that moment, that actually is where you need to add telemetry. You have to add a lot more infrastructure and capability on the data side so you can surface the next group of insights. Because, I really should get a t-shirt, but basically whatever is working today is guaranteed to stop working, right? It's by its nature. It's either going to stop working or you're going to get a diminishing returns problem. And both of those can either be somewhere between detrimental and lethal. So there is a desire in cases where you're at that moment to use what resources you have to continue to scale and continue to get further down that dotted line. But at that moment actually is a critical moment to make sure you have the right kind of data infrastructure in particular in place. Because, you can think of it as, the car analogy, which is you finally figure out how to push on the gas pedal. That's deeply satisfying. And you're like, great, let's go. But it's a dark and windy road, and you need headlights. And so the headlights part of it is, you got to make sure you have all the parts on the car, and headlights are particularly important on a foggy night.
Yeah, one of the things that you're alluding to is that almost every company that we talk to has some amount of technical debt. And as these companies scale, and really I would say more than technical debt, I would call it growth debt, right? Like what is happening in their BI infrastructure, the teams and the data systems to be able to best capitalize on that variable spend. But, as we scale these companies, or as companies scale themselves, they're going to go for a certain period of time where they're going to accept the fact that they're not most optimized because it costs a certain amount of fixed spend to be able to get to that next level. So a question for you is, what are those signals for a company to say, hey, maybe this is the right point to start thinking about investing that next incremental investment into my fixed cost in my BI and my technical stack and my teams to make sure that variable spend is optimized?
The good news is that when you're smaller, there are a number of SaaS tools you can buy that are really good, and they actually work great at the early stages. And so, it's not, you're not flying blind. You can use these tools to be able to, particularly if you're only working in one or two channels. Google is a primary source of either leads or transactions. And so, they work fine. The problem basically is that there is a point at which SaaS-based tools are not sufficient. And there's a chasm actually between sort of the best of the SaaS-based tools and what's required for this next level of growth. And the chasm is basically you need to either hire an in-house team, or you could do, that's essentially what Violet does. It provides a mechanism to be able to get over this chasm. But in any case, you go from being in a situation where it costs you, $500, $1,000 a month to needing 2, 3, 4 people who are working on this full time to be able to set up to allow you to continue to scale in a capital efficient way. Otherwise, you're going to waste a lot of money. And the signals for those are, if you've got a sales force and you're spending media dollars to drive leads to the sales force, those systems traditionally don't connect well together, and it's very hard to tell attribution. So it works for a while, but then as you spend more money, it starts to get harder and harder to tell really where the sale is coming from, and therefore you don't have a way to be able to invest efficiently. So that's one big bucket. The other big bucket is if you start to add many more channels, which is what companies have to do as they scale, attribution becomes a challenge. So if most systems work on last click or enhanced last click, but as you start to enter, either you have a long consideration funnel where it's hard to tell really whether or not last click is actually a good indicator, but more likely you start to add channels like YouTube or native to Taboola and Outbrain and others where you're not really getting a click, right? So it's harder and harder to tell really and link that all together. Then you need more sophisticated attribution tools, and you need to be able to build that into how your folks are buying media every day, or your agency's buying media every day.
Right. So then what does these teams look like when you've had it? Like, let's say that, companies invested the proper amount to be able to build out these teams and this tech stack. Like, what does that solution look like so that somebody can say, okay, we don't have that, or we do have that, and we can have an understanding of what it means to be able to be successful in that area?
Yeah, the problem is that it really is a chasm, because the answer is you need a BI analyst, and you need a couple of data engineers and a tagging engineer, maybe one of each of those, and then you need someone who can interact with the executive staff in other parts of the org who understands enough about marketing to make sure that you're asking for the right KPIs and the right dimensionalize the data the right way, and a set of tools that those people need to be able to understand the data such that they can derive an insight and an opportunity, right, to improve. So it's 3-4 people, and to be able to link those systems together and be able to provide this it's about, best case, it's 9 months of work. So what happens all the time is that people can't justify, they can't justify hiring all those people on the hope that you're going to get an ROI improvement. That's a big risk for a smaller company, arguably even for a bigger company. And so it gets pushed out. Or you have, most common thing is they hire BI and data engineering staff for other uses in the company, because there's always a ton of BI needs, and they hire those folks in, and then the marketing folks have to get their requests in the queue, right? So it's just slow and not as efficient as it needs to be. But the irony of all of this is that for anybody spending, north of $1 million a year in media, the impact of having the right cadence of improvement around your data systems and the ability to surface insights makes that, one of the largest lines on the P&L more efficient. But that it's cross-departmental, right? It's the marketing folks who are saying, hey, I need this. And, often finance or BI is like, well, we're doing the best we can, and we don't really understand what you're asking. And you end up with this sort of cross-boundary challenge, which all leads to, sometimes it's hidden, right? The product's so good, or, the ad markets in that particular sector are such, and the economics are such that you just don't notice for a while. And then, it is Damocles' sword. It's just hanging over you. And all of a sudden you look up and you're like, oh my God, because things are not as effective. Right. And so that, like we talk to folks and they have none of this and they're killing it. Right. Just working, everything's working. And we're like, maybe you get all the way to the end. I don't know. We've never seen that. Most times sooner or later it comes to roost.
You mentioned something which I've seen a lot in companies, which is that it's hard to figure out how to slice and dice which specific functions are going to take ownership over whatever that part of that goal and that objective is, right? And often you have teams that are spread across multiple different functions. And so it's how do you think about that? And I want to talk about that in a specific light. So let's talk about the difference between 3 things: product, growth, and brand. And how do companies think about this? And what's a way to really define each, maybe as a standalone?
Well, I think the distinction here, by the way you frame the question, is actually making one of the critical points, which is that people have a tendency to glom together product and growth or brand and growth, right? Because it often reports to the same person. So you could have a CMO or CGO who is managing product marketing and brand and is also in charge of growth. And they might have someone who works for them as running the growth function. The challenge, I think, is that growth, and when we think about growth, this is basically, math-based how do I get a customer in? How do we retain a customer? How much does it cost me to do that? What are the unit economics around that? What are the channels and messages and so on that I'm going to use to be able to do that? That is separate and apart from brand and product, right? And that portion of it has gotten so technical and complex, particularly as you think about it over time, right? So the challenge is often you have people who are good at startup, growth hacking, figuring out the basics. It's a completely different set of skills going from 10 to 30 and then 30 to 100, let's say, and then 100 to, I don't know, it depends, probably 200, 300. And then it's, it keeps going. Each of those things have their own challenges and complexities. And so, what we think is we've seen work best is making sure that you're thinking about the growth function as something that requires its own investment and is investment in infrastructure and staffing and leadership such that they understand what the state of the art is in a particular sector and be able to stage, right? There's this old thing, which a number of certainly people who have built enormous businesses have found to be true, is that you have to be willing to make really hard choices about people who've gotten you to a certain stage, because often they're just not capable of going to the next stage. And that includes founders, right, and CEOs. It's not unique to people who are actually turning the knobs every day. And that often is the limiting factor. Often people just can't. They just don't know how to, either they don't have the specific skills or they don't have the temperament for that next phase.
You talk about roles. When you think about the two specific roles I want to pull out here, CMOs and CFOs, and the relationship between them, what's important to be able to set up success between those two?
In many, many companies, particularly later in the growth stage, that relationship is fraught. And the reason is because neither of those roles traditionally has domain expertise in the other's area, right? And there isn't often a common language, right? So, and things don't foot and reconcile. So the problem is that CMO is using Google Analytics or, has a variety of tools that says, here's how many leads or how many transactions we drove, and here's attribution. And you're essentially, the problem is often starts with attribution, which is that it's hard to know. In fact, all attribution is wrong. First of all, like you can't. If you add up everybody who says they generated the sale, it's going to be 5 or 6 times what the actual revenue is, right? Because multiple channels and multiple components are going to take credit because they've seen that person pass through, and and so it's a very, very challenging part of this. It's just inexact, and there are ways to use data science and other things to be able to get closer. But at the end of the day, these things aren't right. So you contrast that to the finance world. And by the way, that's just more or less the state of the art. I mean, there's a way to do all this stuff and make it close, but contrast that, that culture, that tribe, right, to the finance tribe, which is if somebody in finance said, well, it's not exact and I'm not sure, there's 3 different ways to look at it. I mean, that person is going to get fired or thrown in jail, right? I mean, that's not allowed in finance, right? You have to be exact. And so when you put those two people together, finance person is like, it doesn't match, right? You're telling me did all these things, or you're asking for more money, or you're telling me what happened, and I'm looking at the numbers and I don't understand what you're telling me, right? And so, and I don't believe it because it doesn't match. Now, the reason it doesn't match is because of the nature of attribution and nature of these systems. And it's actually a meaningful amount of work to get those two things to match up so people can have a conversation. So one of the things that we've seen most effective is you need one source of truth. And then in turn, you have to do the reconciliation work So every time the finance person looks at what's happening in marketing, it's pretty close. It's not exact actually still, but it's, within 3%. So they can say, oh, you did this and things went up. And I can see it went up over here and it went down and went down. And there's a way for them. That's the foundation. That's the bridge. And when you have that, the moment you have that, all of a sudden, a magical thing happens, which is that the CMO and the CFO can talk about how to invest dollars to be able to deliver against the business goal, right? And there's nothing better than that because all of the friction goes away. And now there's a way to be able to say, hey, I'll give you an example of how this conversation goes. CMO comes and says, here we are. Because I have advanced analytics and so on, I can see that we can invest more in this area and get a really high return on it. This particular channel with this particular creative or whatever at this particular moment, right? Pre-holiday, there's a window. We could add a bunch of revenue and a bunch of profit, right? If we act right away. And now the CFO can go, okay, do I need that revenue right now? Do I want to take that? Do I want to add that? Do I want to put those dollars out and wait for them to come back and so on? Can I afford to do that? And all of a sudden they can start to go back and forth. So the best example I have of this, now it's from many years ago, but it's with, my partner in Exactius and co-founder David Manella. He was the CRO at Ideally when I was CEO. And we had this thing where he was so good at this. And I trusted him because the data helped me to arrive at a point where I knew I could. But he had the ability to be able to say, look, and the example I've given before, but it's an interesting one. At the time, the Yahoo homepage, right? Back when Yahoo was everything, right? This was, many years ago, or certainly a big source of traffic. Our total budget at the time probably was, I don't know, $1.3 million a month, maybe it was $1 million, somewhere in that range. But for $350,000, you could buy and own the whole homepage for a day for Yahoo. So it's like a third of the budget or a quarter of the budget, a huge, huge bet on one day, right? And he had tuned this thing so much that he knew that if somebody, and by buying it straight out, it was never in the money. He knew that. He knew he had worked out essentially with really strong data with like a 90% confidence interval, the 2-year lifetime value after 7 days or whatever. So he knew the value of people who were coming from that channel. And he would come to me and say, hey, look, somebody decided not to buy it. This was like in 2009 or whatever, when, companies would, basically turn it back. And in other words, it was on auction and, he knew that he bought it at this price. We were always in the money. And then there wasn't a conversation like, well, it's like, I don't know, do you want the revenue or not? And that, if you can get to that point, everything changes because then you have this control on what's happening in the P&L based on activities in marketing. Everything changes. You're able to, and we by far the most capital efficient of the companies in our sector at the time because we had that type of control. And that's absolutely doable, but it requires a big, big investment traditionally in data infrastructure, specifically growth data infrastructure. And that's what we built it with Exactius, at Exactius with Violet, which is we figured out a way to be able to take that and now 15 years on, we've improved it a million different ways. And over the past 6 years, we built this product, which essentially allows you to manage that and deliver that kind of promise.
You've mentioned that you've had a couple of companies before. This is not your first company. Tell me about some of the mistakes that you've had and so some things that maybe you are sure you're never going to make that same mistake again.
Well, how much time do you have? Because I have a lot of mistakes.
We'll just pick one. We'll pick one for today.
Actually, I'll tell you, I am surprised by my after being emphatic that I would never do certain things again, I find myself doing them again, which I can't tell is whether or not it's a memory problem or what. But it's easy to fall into patterns and kind of go backwards. But I think an example of something where a mistake that I've made in the past that I think is really important to avoid is conflating what's happening in your business with what's happening in the world around you at the same time. I've always felt that entrepreneurs, in order to do it at all, have this fallacy of agency, meaning that they think that they can make something out of nothing, right? And build something big. Like it's incredibly hard to do, right? Notwithstanding the fact that it looks like it's a piece of cake, as we read, this person started out of their garage and, with the 3 postage stamps, and then they have a $5 billion business in 18 months. Like it's really hard to do. Okay. And so, but entrepreneurs were like, I don't know, why not? Let's do it. And that's critical. Like that delusion is a critical component of success because you have to be willing to just assume that you're going to make it. But the counterfactual to that is that everything you're doing is colored by where you are in the business cycle or where you are in the private company capital markets and so on. So there's in my career, it's just terrifying to say, I've been doing it 40 years. So I've been starting companies. And there have been times where I literally could have had a gold brick printing machine and it wouldn't have mattered. I couldn't raise a nickel on it. And other times, basically everything got funded, every bad idea on the planet. And you can see it, and it has to do with it's a cycle, right? And so I think a critical thing that I've realized is you have to make sure that you take a moment to see which pond you're swimming in as you're making decisions on what kind of company to start, but also how to run your company in that moment.
We get the opportunity to talk to a lot of investors as well, venture capitalists and private equity. And a lot of them, especially when they focus on that growth stage, are looking at the numbers with a level of scrutiny that they really haven't in the past. And I mean, it's a whole new paradigm in understanding what is going to take for these companies to scale and what numbers need to be true to be able to execute on that. Both when the private equity owns the company or owns big parts of it, and even in venture when they're coming in, they're saying, hey, if you're going to get this next round, this is what has to be true. What do you think would be important for founders to know about this relationship today, and what has to be true about their data systems and how they're thinking about growth for them to be able to get into that next round?
Investors' interests and entrepreneurs' interests are not always aligned, right? I mean, particularly in venture, what venture firms need to find are companies that are going to grow an extraordinary amount to be able to return the fund. But there is one place that they are aligned, and particularly for entrepreneurs and operators trying to figure out how to maximize their personal returns in the companies that they're building, is that if an entrepreneur is in a situation where they can see, they have an option to not take money, but they also can see if they put $1 in, they can see the return they're getting, and they have an idea of where that curve starts to flatten out. If you are able to do that, you can make a decision in the context of an investment with a return. So you could say, so simple math on this. Let's say you're a $10 million business. And you have the right type of telemetry to know that if there's a clear path to be able to take your marketing spend from $1 million to $2 million and grow twice as fast, still hitting or improving on the unit economics that you have. And that's the definition of scaling, by the way. Growing is the top line goes up. Scaling is the top line is going up, but you're improving the business in terms of its efficiency as you grow. That's scaling, okay? And so if you have a way to see that you can scale if you put more dollars in, then you have an investment decision to make, and you can make that, you can actually it's a math problem, which is I'm going to take some dilution, but I can see for instance, if I grew, if I grew from 10 million and I was growing at 40% a year as opposed to 20% a year, well, that company is A, worth more because the top line has gone up and you've improved the unit economics. But the other reason is because that company's more valuable because it's growing faster. So you're going to get a higher multiple. So you can do the math on that and say, okay, now I can figure out dilution. Now, the minute you're able to do that as an entrepreneur, the value of your business to an investor skyrockets because now, certainly how PE guys want to think about this problem, but venture guys too. Like if you have a way to be able to know, oh my God, like that, we're talking about true growth capital. Well, that's a whole different thing. And, most companies are not able to do that with the level of specificity that they should, given the fact that they work there every day and they're highly concentrated, right? Every entrepreneur, every operator, executive, it often represents their best chance at being able to get life-changing wealth. Like, don't fly blind. That's nuts.
Or, their only chance in many cases.
Well, until the next one, right? Right. If you're at the end of the line, maybe it's your only chance. But people, whatever. I've taken multiple swings at this, and but the point is, if you're in it, the more visibility you have, and the more risk you can take out of the growth equation, that is absolutely a critical part of it, and is way, way underappreciated today.
That brings me to another thing, which is that being the number one player in an industry, in a space, is going to be drastically different in terms of what your returns are going to be than if you're going to be the third player or the fourth player, even if the differences between those numbers aren't that dramatic when you actually look at the sheet. So tell me a little bit about that and your understanding of why is it important to have that incremental win in the growth stage when it comes down to, as a CEO, focusing on making sure that you get the best enterprise value that you can?
What I'd say, obviously being the leader, there's all kinds of research that shows that being a leader, you have all kinds of things accrue to you. You essentially have, it's just easier to stay the leader, accelerate. However, there's a counterfactual there, which is really important, which is that there are a million examples, or not a million, many, many examples of companies that were leading and who have their lunch eaten by a disruptor or whatever. That's a key theme in venture investing, obviously. So what is that? Often those are product innovations or business model innovations. Dell's an old example of this, going direct versus people selling computers and dealers. There's many, many, many examples of this. But the other thing that actually happens and can be a disruptor too is a staggering amount of resources are wasted because people have dollars to spend and there's just floppy thinking. And in fact, people can come eat your lunch. So, and the way you know this is because Meta and Google's stock price, was one of the great investments over the past, 15, 20 years, because, people are like, I don't know, it cost me $1,000 to acquire a customer. So I'm going to multiply that out and that's what's going to be. It's like, well, why isn't it 500? Could you make it 500? Do you have a way to make it 500? And that's a huge difference. And, it's interesting because the research we've done at Exactius and a variety of companies, there are examples where just by really looking at the data and trying to derive insights about what was true, you can come from nowhere and with a lot less money, a lot less marketing dollars, and win, right? And beat much larger companies that are spending an incredible amount of money because, the ability to, these are order of magnitude changes, right? You could have, we've seen situations over the years where people, have wasted tens of millions of dollars, hundreds of millions of dollars in media that they just didn't optimize because they had the money and it was working well enough or whatever. But that's not, and there was a lot of risk in that. So if you can, there's a way to do better by starting with building putting headlights on the car, strong infrastructure, and then having a culture around trying to derive insights from that, and then test very rapidly and try to find ways to improve.
Paul, we're out of time, but thank you. This was very interesting. I appreciate it.
Yeah, thanks for making time, Zan.